Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone out there for all of your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today, I just quickly want to jump back into the portfolio and talk about a few different things with regards to options trading. I'll use my first contract that I sold off, my first options trade as an example. There was a number of comments regarding, do you need collateral in your account before you do an options contract? And the second question was, do you have to fulfill a particular contract? Is it obligated, or do you have the right to not fill that contract? So we'll talk about those two very basic things with regards to options contract. First of all, let's talk about the portfolio here. As you can see here, another very good day in the markets and a very good day in the portfolio as well. You can see up top there in the green today, active hours trading 1.67% in the green, 24.37. 81 with quite a bit extra in after hours trading as well, 0.52% of the overall portfolio, and after hours trading alone 776.20. A lot of that has to do with my two largest holdings in the portfolio. Portola, as you can see in the middle here, up 6.25% with a lot of movement in after hours trading there, up 0.89, 2.69% in after hours trading. And then we'll go down to Ford. And Ford is the stock I have my options contract with currently. You can see also a very good day with Ford here, up 1.61%. So let's go down to the option section. Again, if you have an option with a particular stock, you can see it has a new menu that pops up here. If you go ahead and click on that, you'll see all my positions on the bottom here. So again, I sold off a contract. We'll talk about a little bit about what the differences are if you are a holder of a contract versus if you are selling off a contract. There are different obligations for that, as well as why to get into options. So let's go ahead and start with that first. As you can see in the middle there, total return is up 30.23%, $13 return. And the way this contract works is that I sold off this contract, so another investor holds this contract. They paid me 43 cents per share. Again, each contract is worth 100 stocks. So essentially, they paid me $43, a credit to my account, in order to receive that contract. So I essentially wrote that contract, and they received the contract. So I was the writer of the contract. The other investor is the holder of the contract. As a writer of a contract, if you sell off a contract, you are obligated to fulfill that contract. So for this particular position here, if the investor wanted to exercise that option, I would have to buy this particular stock from that investor as the price up on top here. As you can see, $9.87. So I have to do that as the writer of the stocks. That's true for both puts and calls. However, if you buy a call, if you buy a put, you don't have to necessarily exercise that option. You are not obligated to buy or sell if you are the holder. So if you went ahead and paid, for example, the other investor paid $43 for this option, they would not have to be obligated to buy or sell, whether that was a call or a put. But if you did write that contract, like for this trade here, I wrote the contract. I did one sell put for this contract. I basically sold a put to another investor. They paid me money, but if they want me to exercise this, I have to do that. I'm obligated to do that. And because of that, you can see on the bottom there, I have a cash collateral, $987. That's essentially tied up right now in the account. If you buy puts, calls, that does not happen. But on the other side, if you are the writer of the contracts, as you can see here, you do have to have that cash collateral in the account. So that is why it's a little bit different between if you buy a call or put or if you are selling a call or put. If you are the holders, if you are buyers, you are not obligated to buy or sell. If you are writers, if you are sellers, you are obligated to buy or sell. So very important difference there. And then the second part of that is why get into options? Well, you can see there, I put a little bit of money into Ford here, but I have a 30.23% return. Options really have the performance of penny stocks, but you don't have necessarily the risk that comes along with penny stocks. You can do options trading in blue chip companies, very solid companies, really have a lot more security in the underlying asset that you are trading with. With penny stocks, as I've talked about on a number of prior videos, it's very risky jumping into penny stocks because a lot of the time these are not very good companies. These are companies that are traded very, very quickly between investors. They have high volumes and they have very high price swings, which really accounts for the great returns. With risk comes reward, but options is a much easier way of getting that return and managing risk. So that is why options are so powerful. You can see here, just a couple days worth of trading here, I've already made 30.23%, and you can see how that would scale if I bought more than one contract. If I sold more than one contract, you can make quite a bit of return in a very short amount of time. Again, risk equals reward, so there is risk in options trading. It's definitely higher than buying individual stocks, individual securities, but there is also that very nice return that can go along with options trading. So those are the reasons why investors get into options trading. You can have very nice rates of return, not necessarily have to put a lot of capital into the market. If you sell the contracts, you have to have collateral. If you buy the contracts, you simply pay another investor for that particular contract, and you don't really have to put any more money into the stock than that and get a nice return. Again, depending on how much you are willing to put into the market. There's an upfront cost, but the reward is quite substantial in a majority of cases. Again, that can go both ways as well. You can lose quite a bit of money quite quickly if you don't know what you're doing with options. So that's kind of why I'm going to jump in very slowly here, really learn about all the different ways of trading. It gets quite complex. Even after you know all of the different ways in which to trade, there are a number of variables. As you can see here on the bottom here, stats, a lot of new types of statistics here. Implied volatility, for example. We'll go through a video series here as well, going through all of these numbers. The Greeks, for example, this gets quite theoretical and it gets quite complicated. So I'm going to do this very, very slowly, and I'm only going to jump into a few positions here before I really start using a lot of capital in options trading. So those are the reasons, and that is why options trading is so beneficial to investors. And again, there is a big difference between if you are the holder, equaling buyer of a contract, you are not obligated to buy or sell. But if you are the writer, equaling the seller, you are obligated to buy or sell in whatever contract that you are associated with. So just wanted to quickly go over that. I know there was a few questions, quite a few viewers asking similar questions about that. Why jump into options trading? What is the benefit? As well as why was there a cash collateral on that trade that I did with Ford here? And that is why, because I was the seller of that option to another investor. So again, I'm going to be going through all of the other options trading strategies and other videos. I put out the first part this past week. I'll be putting out parts 2 for 4 over the next few weeks. Again, going through all of the different ways in which you can trade options, which you can see here in this menu. You can do a number of different things. You can buy, for example, buy a call. You can buy a put. You can also sell a call or sell a put, and that is what I did with Ford there. I sold a put, and that is why I had to have that cash collateral, because I was the seller on that options contract. So I don't want to go through too many things on this video. I know I went through quite a bit of things. Just wanted to answer those questions for those viewers that were wondering about those two things. Why jump into options, and why was there a cash collateral needed on my options trade? So let me know how you guys are doing with your options trading. Are you diving in yet? Are you learning a little bit more before you start actively trading with options? Like I said, I'm going to be taking this very slowly, putting in a little bit of capital, both buying contracts as well as selling off contracts, buying calls, buying puts, as well as selling calls and selling puts, to kind of see how this works. Then I'm going to be going through and really researching all of the variables behind options contracts, the different strategies that are employed, as well as all of the stats that are associated with trading options as well. So let me know how you guys are doing this, what trades you are favoring. And not to make the video too long, I'll kind of end it here. Again, if you guys have any questions about this video, other videos, please let me know in the comment threads down below. I'll do my best to get back to you guys as quickly as I can. And if you guys have any good video ideas, please let me know. Always looking for new things to research and read up about. And definitely we'll put out a video if there is enough interest in any one particular topic. So kind of with that, I don't want to make the video too long. I'll kind of end it here, and we'll see you guys next time.